Question 1. A key consideration in the underwriting process is evaluating the risk associated with a policyholder. Which of the following is the most commonly used method by underwriters to assess the financial impact of past claims on the current application? A. Actuarial data. B. Claims history analysis. C. Loss ratios. D. Credit score analysis. Answer: B. Claims history analysis. Explanation: Claims history analysis is a crucial tool in assessing the potential risk associated with underwriting an individual or business. Underwriters examine past claims to determine whether a policyholder is likely to make future claims and evaluate the financial impact of these claims. Actuarial data, option A, and loss ratios, option C, are also used, but they are part of broader statistical models that take past claims into account, rather than focusing directly on the individual's claim history. Credit score analysis, option D, is more relevant to personal lines underwriting, particularly in determining premium rates, but not directly linked to the financial impact of prior claims. Question 2, scenario question. Mr. Anderson applies for a homeowner's insurance policy. He discloses that his house has had a history of water damage, but the issue was repaired over a year ago. He does not provide any additional information regarding ongoing risks or measures taken to prevent future damage. What should the underwriter do next in this situation? A. Accept the application without any further investigation as the damage has been repaired. B. Reject the application outright as the house has a history of water damage. C. Request more detailed information regarding the repair's current condition and prevention measures to assess future risk. D. Issue a policy with a higher premium to account for the potential risk. Answer: C. Request more detailed information regarding the repair's current condition and prevention measures to assess future risk. Explanation: The underwriter should not accept the application without further investigation, option A, because the history of water damage is a significant risk factor that could affect the future insurability of the property, while rejecting the application outright. Option B is a possible action. It is not necessary unless further investigation reveals an ongoing risk. In this case, asking for additional details, option C, is the best course of action to determine whether the repairs are adequate and whether preventive measures have been taken to reduce the likelihood of future damage. Simply issuing a policy with a higher premium, option D, without considering the full details could result in inadequate coverage or improper risk assessment. Question 3. Which of the following is the primary purpose of using credit scores in the underwriting process for property and casualty insurance? A. To determine eligibility for coverage. B. To assess moral hazard in applicants. C. To predict the likelihood of future claims. D. To evaluate the applicant's previous financial behavior. Answer: C. To predict the likelihood of future claims. Explanation: The use of credit scores in property and casualty underwriting is primarily to predict the likelihood that an applicant will file claims in the future. Research has shown that individuals with lower credit scores are statistically more likely to file insurance claims. This information helps underwriters assess the potential risk associated with the applicant, while credit scores can indirectly reflect an applicant's financial behavior. Option D. They are not primarily used to determine eligibility. Option A. Or assess moral hazard. Option B. The key purpose is risk prediction related to claims likelihood. Question 4. In life insurance underwriting, when evaluating an applicant's health, which of the following is considered the most significant factor when determining premium rates for high-risk policies? A. Family medical history. B. Current medications. C. Lifestyle factors such as smoking and alcohol use. D. Occupation and travel habits. Answer: C. Lifestyle factors such as smoking and alcohol use. Explanation: Lifestyle factors such as smoking and alcohol use have the most significant impact on life insurance underwriting for high-risk policies. Smoking in particular is associated with a higher risk of serious health conditions, which increases the likelihood of death and can significantly raise premiums. Family medical history, option A, is also important but secondary to an individual's current behaviors. Current medications, option B, can indicate existing health conditions, but lifestyle choices often have a more profound impact on the underwriting process. Occupation and travel habits, option D, can also be factors, but are less influential compared to lifestyle choices. Question 5, scenario question. Mr. Taylor is applying for a commercial property insurance policy for his new business. The business is located in an area prone to flooding, but Mr. Taylor has taken preventive measures such as elevating the property and installing flood barriers. What should the underwriter do when reviewing the application? A. Reject the application due to the high risk of flooding in the area. B. Accept the application without further investigation as preventive measures have been taken. C. Request additional information about the flood prevention measures and assess their effectiveness before making a decision. D. Increase the premium for the policy based on the potential flood risk without further investigation. Answer: C. Request additional information about the flood prevention measures and assess their effectiveness before making a decision. Explanation: the underwriter should not make an immediate decision based solely on the presence of flood risk, option A, or simply accept the application without further investigation, option B. It is important to assess the effectiveness of the preventive measures in place, option C. This includes evaluating whether the flood barriers are at and the property elevation sufficiently mitigates the risk. Increasing the premium without a proper assessment, option D, is premature and could lead to incorrect pricing if the preventive measures prove effective. Question 6. When determining the premium for a property insurance policy, which of the following is not a common factor used by underwriters to assess the risk level? A. Property age and condition. B. Location and environmental risks. C. The applicant's personal income. D. Claims history. Answer: C. The applicant's personal income. Explanation: while underwriters consider various factors in determining premium rates, personal income, option C, is generally not one of them for property insurance policies. Factors such as property age and condition, option A, location and environmental risks, option B, and claims history, option D, are key components in assessing the risk level of insuring a property. Income might be more relevant in life insurance or liability coverage where an applicant's financial situation impacts policy decisions, but for property insurance, it is not a direct consideration. Question 7. In Indiana, under which of the following circumstances can an underwriter legally deny an insurance application based on credit score? A. If the applicant's credit score is below the state-established threshold. B. If the applicant's credit score reflects history of bankruptcy or fraud. C. If the applicant's credit score is above the average for their age group. D. If the applicant refuses to provide their credit score. Answer: B. If the applicant's credit score reflects history of bankruptcy or fraud. Explanation: in Indiana, as in many other states, an underwriter can deny an insurance application based on credit score if it indicates significant financial risk, such as history of bankruptcy or fraud, option B. However, low credit score alone, option A, is not sufficient grounds for denial without further context. High credit score, option C. Refusal to provide credit score, option D, does not justify denying an application. If the applicant refuses to provide their credit score, the underwriter may proceed with alternative risk evaluation methods, but denial based solely on non-disclosure is not permitted. Question 8. Which of the following underwriting tools helps an underwriter assess the likelihood of catastrophic events affecting the policyholder's property? A. Actuarial tables. B. Risk classification systems. C. Hazard analysis. D. Loss history. Answer: C. Hazard analysis. Explanation: hazard analysis, option C, is the primary tool used by underwriters to evaluate potential risks such as natural disasters, fires, and other catastrophic events that could affect the policyholder's property. This analysis examines environmental, operational, and geographical factors that might increase the likelihood of these events occurring. Actuarial tables, option A, are useful for determining statistical probabilities, but are not specifically tailored to catastrophic events. Risk classification systems, option B, and loss history, option D, are used to assess general risk levels, but are not as focused on large-scale hazards as hazard analysis. Question 9. When conducting post-underwriting activities, which of the following is the primary responsibility of the underwriter? A. Collecting the initial premiums from the policyholder. B. Issuing the policy and handling endorsements and renewals. C. Handling claims and determining payouts. D. Providing customer service for general inquiries. Answer: B. Issuing the policy and handling endorsements and renewals. Explanation: after the underwriting decision is made, the primary responsibility of the underwriter is to issue the policy and handle any endorsements or renewals that may be needed. Option B. The underwriter ensures that the policy accurately reflects the terms and conditions agreed upon during the underwriting process, while collecting premiums option A and handling claims option C. Important tasks. These responsibilities typically fall to the insurer's customer service and claims departments, not the underwriter. Providing customer service for general inquiries option D is also outside the typical role of the underwriter. Question 10. In the context of reinsurance, which of the following describes the type of reinsurance agreement where the ceding insurer transfers a portion of all risks for a specific line of business to the reinsurer? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Proportional reinsurance. Answer: B. Treaty reinsurance. Explanation: treaty reinsurance option B involves an agreement between the ceding insurer and the reinsurer to automatically transfer a specified portion of risks for a particular line of business, such as property or casualty, based on pre-agreed terms. Facultative reinsurance option A refers to the reinsurance of individual risks rather than an entire line of business. Excessive loss reinsurance option C and proportional reinsurance option D describe specific structures for the distribution of losses, but are types of reinsurance agreements that are typically used under a treaty or facultative arrangement, depending on the scope of coverage. Question 11. Which of the following is a primary purpose of the insurable interest requirement in insurance contracts? A. To ensure that the insurer only covers risks that the policyholder can afford. B. To prevent fraudulent claims. C. To limit the number of claims a policyholder can file. D. To determine the premiums based on the policyholder's wealth. Answer: B. To prevent fraudulent claims. Explanation: the requirement of insurable interest ensures that the policyholder has a financial stake in the subject of the insurance contract, which prevents individuals from taking out insurance on objects or persons they have no direct connection to, thus minimizing fraudulent claims. Question 12. When underwriting a property insurance policy, which of the following factors would not typically influence the risk assessment? A. The building's construction materials. B. The policyholder's previous claims history. C. The presence of fire alarms or sprinkler systems. D. The policyholder's employment status. Answer: D. The policyholder's employment status. Explanation: the policyholder's employment status generally does not affect the underwriting of a property insurance policy. Factors such as the building's construction materials, previous claims history, and safety systems like fire alarms and sprinklers are key to assessing the property's risk. Question 13. Which type of insurance policy would be most appropriate for a business that wants to protect itself from third-party claims for bodily injury or property damage? A. General liability insurance. B. Workers' compensation insurance. C. Property insurance. D. Business interruption insurance. Answer: A. General liability insurance. Explanation: general liability insurance protects a business from third-party claims for bodily injury or property damage caused by the business's operations, products, or employees. Workers' compensation insurance covers employee injuries, property insurance covers business property, and business interruption insurance compensates for lost income due to disasters. Question 14. Which of the following statements is true about the insurance principle of utmost good faith? A. Both parties must disclose all relevant facts honestly before a contract is signed. B. The insurer is responsible for revealing all potential risks to the policyholder. C. The insured must only provide information if the insurer specifically asks for it. D. The insured is required to disclose only the risks they are aware of. Answer: A. Both parties must disclose all relevant facts honestly before a contract is signed. Explanation: the principle of but most good faith requires both the insurer and the insured to disclose all material facts that could affect the terms of the contract. Failure to do so could lead to the cancellation of the policy or denial of a claim. Question 15. Scenario question. Sarah has applied for a life insurance policy, but she has a pre-existing medical condition that she failed to disclose on her application. After a few months, Sarah passes away unexpectedly. What is the likely outcome of her life insurance claim? A. The claim will be paid, as Sarah did not intentionally conceal her medical condition. B. The claim will be denied because Sarah did not disclose her pre-existing condition. C. The insurer will pay only the partial amount of the death benefit. D. The insurer will delay the claim pending further investigation. Answer: B. The claim will be denied because Sarah did not disclose her pre-existing condition. Explanation: If a policyholder fails to disclose a material fact, such as a pre-existing medical condition, it can lead to the denial of the claim even if the death occurs unexpectedly. The insurer relies on full and accurate information to assess risk properly. Question 16. What is the term for the part of an insurance policy that specifies the perils or causes of loss that are covered under the policy? A. Insuring agreement. B. Exclusion clause. C. Declarations page. D. Endorsement. Answer A. Insuring agreement. Explanation. The insuring agreement outlines the perils or causes of loss that are covered under the policy. It is one of the most important parts of an insurance contract because it specifies the coverage provided. The exclusion clause, option B, lists what is not covered, while the declarations page, option C, summarizes the basic terms of the policy. An endorsement, option D, is a modification to the term insurance policy. Question 17. Which of the following is true regarding the coinsurance clause in health insurance? A. The insured must pay a fixed percentage of all claims, regardless of the amount. B. The insurer will cover all medical expenses after the deductible is met up to the policy limits. C. The insured is required to pay a percentage of the medical expenses after the deductible is met. D. The insured pays the coinsurance amount directly to the healthcare provider. Answer. C. The insured is required to pay a percentage of the medical expenses after the deductible is met. Explanation. The coinsurance clause requires the insured to pay a percentage of the covered medical expenses after meeting the deductible. This helps to reduce the insurer's financial risk while sharing costs with the insured. Question 18. Which type of reinsurance arrangement allows the reinsurer to accept or reject individual risks on a case-by-case basis? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Proportional reinsurance. Answer A. Facultative reinsurance. Explanation. Facultative reinsurance allows the reinsurer to evaluate and accept or reject individual risks on a case-by-case basis. This type of reinsurance is typically used for high-value or unusual risks that do not fall under an automatic treaty agreement. Question 19. In which of the following cases would an insurance policy be voided due to the misrepresentation clause? A. The insured knowingly provides false information on their application. B. The insurer fails to disclose all policy terms clearly. C. The insured accidentally omits a minor detail during the application process. D. The insurer increases premiums based on the insured's previous claims. Answer A. The insured knowingly provides false information on their application. Explanation. Misrepresentation occurs when an insured knowingly provides false or misleading information on their application. This can lead to the policy being voided. Accidental omissions, option C, typically do not result in voiding the policy, but intentional misrepresentation, option A, will. Question 20. Which of the following best describes subrogation in insurance? A. The insurer compensates the insured after a claim is made. B. The insurer recovers money from a third party that caused the loss. C. The insured pays a portion of the claim amount. D. The insurer raises premiums after a claim is paid. Answer B. The insurer recovers money from a third party that caused the loss. Explanation. Subrogation allows the insurer to recover costs from the third party that was responsible for causing the loss once the insurer has paid the claim to the insured. This helps keep premiums lower and prevents the responsible party from avoiding financial responsibility. Question 21. When underwriting a life insurance policy, which factor is least likely to affect the underwriting decision? A. The applicant's age. B. The applicant's smoking history. C. The applicant's occupation. D. The applicant's credit score. Answer D. The applicant's credit score. Explanation. In life insurance underwriting, factors such as age, smoking history, and occupation can directly influence the risk level. However, the applicant's credit score typically does not play a significant role in underwriting decisions for life insurance policies. Question 22. Which of the following is true about the substandard rating classification for life insurance? A. It indicates that the applicant has a history of risky behaviors but is still eligible for coverage. B. It means that the applicant is ineligible for coverage under any circumstances. C. It applies to applicants who are eligible for standard coverage with an additional rider. D. It applies only to individuals who have no pre-existing health conditions. Answer A. Indicates that the applicant has A history of risky behaviors but is still eligible for coverage. Explanation that substandard rating classification applies to individuals who present higher than average risk due to factors such as risky health conditions, occupation, or lifestyle choices. While these applicants can still be insured, they will typically face higher premiums. Question 23. Which of the following is not typically covered under a standard homeowner's insurance policy? A. Fire damage to the structure. B. Theft of personal belongings. C. Damage from flood. D. Liability for injuries on the property. Answer C. Damage from a flood. Explanation. Flood damage is typically excluded from standard homeowners insurance policies, requiring separate flood insurance policy for coverage. Fire damage, option A, theft, option B, and liability for injuries, option D, are typically covered under most homeowners policies. Question 24. Which of the following represents an example of a moral hazard in insurance? A. A business owner who fails to maintain their property, leading to greater risk of damage. B. A homeowner who builds their house in a flood-prone area without insurance. C. An insured who purposely sets a fire to collect insurance benefits. D. An individual who purchases insurance after a disaster has already occurred. Answer C. An insured who purposely sets a fire to collect insurance benefits. Explanation. A moral hazard refers to a situation where an individual or entity takes on greater risks because they do not bear the full consequences of those risks. Purposely setting a fire for financial gain is a clear example of moral hazard. Question 25. Which of the following best describes the waiting period in disability insurance policies? A. The amount of time the insured must wait before they can file a claim. B. The period during which the insurer decides whether to accept or reject the application. C. The duration that the policyholder must be disabled before they begin receiving benefits. D. The length of time the insurer will pay disability benefits after an accident occurs. Answer C. The duration that the policyholder must be disabled before they begin receiving benefits. Explanation. The waiting period in a disability insurance policy refers to the time an insured must wait after becoming disabled before they can begin receiving benefits. This period is designed to prevent small, temporary disabilities from being covered under the policy. Question 26. Which of the following is an example of a hazard in insurance terms? A. A fire that causes damage to a home. B. An individual who frequently smokes while living in a wooden house. C. A property that has been damaged in an earthquake. D. A policyholder who files a claim after an accident. Answer B. An individual who frequently smokes while living in a wooden house. Explanation. A hazard in insurance refers to a condition or situation that increases the likelihood or severity of a loss. In this case, smoking in a wooden house increases the risk of fire, making it a hazard. A hazard is not the event itself, but the factor that increases the risk of a loss happening. Question 27. Which of the following is a characteristic of a whole life insurance policy? A. It provides coverage for a specific term and builds no cash value. B. It is a type of permanent insurance that accumulates cash value. C. It covers only the policyholder's life and not the beneficiaries. D. It only pays out if the policyholder passes away during the first year. Answer B. It is a type of permanent insurance that accumulates cash value. Explanation. Whole life insurance is a type of permanent life insurance that provides lifelong coverage and accumulates cash value over time. The premiums typically remain fixed and the policy's cash value grows at guaranteed rate. Question 28. What is the primary purpose of an umbrella policy in insurance? A. To provide additional coverage beyond the limits of the underlying policies. B. To cover risks that are not covered by any other insurance policy. C. To limit coverage for specific types of liability claims. D. To reduce the amount of premiums for underlying policies. Answer A. To provide additional coverage beyond the limits of the underlying policies. Explanation. An umbrella policy provides extra liability coverage above the limits of the policyholder's primary insurance policies, such as auto or homeowners insurance. This coverage is designed to protect against major claims that exceed the limits of other insurance policies. Question 29. Scenario question. John has a car insurance policy with a $500 deductible. After an accident, the repairs cost $3,000. How much will John have to pay out of pocket for the repairs? A. $3,000. B. $2,500. C. $500. D. $3,500. Answer B. $2,500. Explanation. John will have to pay the $500 deductible before the insurance company covers the rest. The total cost of the repairs is $3,000, so after subtracting the deductible, John will pay $2,500 out of pocket and the insurance company will cover the remaining $2,500. Question 30. Which of the following is true about premium payments in an insurance contract? A. Premiums are always paid annually regardless of the policy type. B. Premiums are paid by the insurer to the insured. C. Premiums are paid by the policyholder to the insurer to maintain coverage. D. Premiums are paid only when the insured files to claim. Answer: C. Premiums are paid by the policyholder to the insurer to maintain coverage. Explanation: Premiums are the amount the policyholder must pay to the insurer in exchange for coverage. These payments are typically made on a monthly, quarterly, semi-annual, or annual basis depending on the terms of the policy. The insurer does not pay premiums to the policyholder, and premiums are unrelated to filing claims.